Welcome to The Explainer. Today, we're diving straight into the absolute triumphs that was the first quarter of 2026 for Goldman Sachs. We're going to unpack the mechanics behind their massive revenue generation, and just as importantly, we'll look at their underlying capital safety. It's a fascinating quarter, so let's get right into it. Here's our quick roadmap. We're going to break down how they completely smashed Wall Street expectations, how they dominated global M&A, and how they proved their resilience in the Fed's latest stress tests. Starting with Section 1, Q1 2026 record earnings and smashing those Wall Street expectations. Now, these are the headline numbers that basically force the entire financial sector to do a double take. Wall Street analysts had the consensus estimate for earnings per share pegged at $15.92, while Goldman easily cleared that bar. They delivered a massive beat of $1.63, bringing their actual EPS to $17.55. Listen, in the world of mega-cap banks, a beat of that magnitude, it's a huge signal of underlying operational strength. And, that EPS beat didn't just happen by magic. It was driven by this towering figure right here, an unbelievable quarterly net revenue of $17.23 billion. To put that into perspective, it completely blew past the estimated $16.66 billion. That's a 14% jump year over year, making it their second highest net revenue quarter on record. For investors, this is the ultimate proof that their core money-making engine is just firing on all cylinders. But here's the thing, it wasn't exactly smooth sailing out there. As CEO David Solomon rightly pointed out, this record-breaking performance was achieved despite a really volatile, highly complex global landscape. The takeaway here is that Goldman didn't just passively ride a wave of easy money. They actively, carefully managed their risk while still capturing massive upside. Okay, Section 2, driving the revenue machine. Let's break down exactly where that $17.23 billion came from. So Goldman's business is heavily weighted toward its traditional strengths. The absolute lion's share of the revenue engine is global banking and markets, pulling in an astounding $12.74 billion. That's supported by a very solid $4 billion plus from asset and wealth management. Platform solutions is still a much smaller piece of the pie at $411 million, which makes sense as they continue to transition away from consumer-facing ventures like the Apple Card. Now, if we look closer at that massive global banking and market segment, there are some really fascinating internal dynamics. Equities brought in a record $5.33 billion, which is up 27%. But the real showstopper, investment banking fees, they literally skyrocketed by 48% year over year to hit $2.84 billion. FICC, that's fixed income, currencies, and commodities, was the only slight drag, down 10%, mostly due to lower revenues in interest rate products and mortgages. Meanwhile, the wealth management side of the house is quietly building an absolute fortress. They hit an all-time high of $3.65 trillion in assets under supervision. Think about that for a second. What you really need to take away here is the consistency. This marks 33 consecutive quarters of long-term, fee-based net inflows. Wealth management gives them that steady, predictable fee revenue that perfectly balances out the bumpier trading and banking segments. Moving to Section 3. Dominating global mergers and claiming the #1 spot in M&A deal value. So remember that crazy 48% jump in investment banking fees we just talked about? Well, this is the catalyst. According to Q1 2026 stats from Global Data, Goldman Sachs didn't just participate in the M&A market, they completely owned it. Ranked first globally, they advised on a staggering $267 billion worth of deals. Even crazier, they were involved in 27 different billion-dollar deals, including 7 literal mega deals valued over $10 billion each. Simply put, when the biggest companies in the world wanted to make a move this quarter, they called Goldman. And just to put that dominance into context, while they were slightly behind Houlihan Lokey in pure deal volume, in terms of total deal value, they thoroughly outpaced their closest major rival, Morgan Stanley. They beat them by over $50 billion for the quarter. That's a massive gap at the top. Section 4. Stress tests and capital. Let's talk about proving financial resilience. Look, making record money in a good quarter is fantastic. But to understand a bank's true resilience, you have to look at how safe their capital is when things go south. That's where the Federal Reserve's CCAR stress tests come in. Essentially, the Fed simulates a catastrophic global recession just to make sure these banks won't collapse. They stress test revenues, expenses, and capital losses under horrific hypothetical conditions to ensure the firm can survive a severe downturn. Based on those brutal tests, the Fed calculates a strict capital requirement. For Goldman, the baseline minimum common equity tier 1, or CET1 ratio, is 4.5%. You can think of CET1 as a bank's core, highest quality break glass in case of emergency cash reserves. Add in a stress capital buffer of 3.4%, plus a 3.5% surcharge for being a massive, globally important bank, and you get a total regulatory CET1 requirement of 11.4%. And the Fed confirmed that requirement is holding steady through late 2027. Okay, so the government requires 11.4%. How did Goldman actually do? Honestly, they crushed it. They comfortably exceeded that regulatory minimum, ending the first quarter with an actual CET1 ratio of 12.5%. That delta between the required 11.4 and the actual 12.5 represents literally billions of dollars in excess capital. It acts as a massive shock absorber for the entire firm. Which brings us to Section 5, Forward Outlook and Dividends, how they're rewarding the shareholders. So what does this potent combination of record revenues and robust capital actually mean for you, the investor? Well, armed with all that excess capital, Goldman went straight to rewarding its shareholders. They announced they're hiking their common dividend by 11%, bumping it up from $4.50 to $5 per share, starting in July 2026. Make no mistake, that is a loud, clear signal of management's absolute confidence in their ongoing cash flow. And looking ahead, if we peek at the market beat data, we see the stock trading at a trailing price-to-earnings ratio of 18.5. But the really interesting number is the forward PE, which sits at a leaner 16.93. Because earnings per share are projected to grow nearly 11% next year, the stock is effectively getting cheaper relative to its future earnings power. The market clearly expects this revenue engine to keep right on humming. So what does this all mean for the big picture? Goldman Sachs has undeniably proven they can print massive profits while keeping their balance sheet absolutely bulletproof. But as we heard from David Solomon earlier, the global stage is still incredibly volatile. So with these staggering Q1 numbers as their foundation, the true test going forward is this. Can Goldman maintain this phenomenal M&A momentum and record growth in a world that's only getting more unpredictable? It's going to be fascinating to watch. Thanks for joining me for this explainer, and keep your eyes on how these markets develop.